Hey, everybody. Thank you so much. I'm very excited for this panel. So we were talking about how I introduced it as the last panel. So I'm not going to say that this panel is holding you from drinks, but drinks are holding you from having this panel go on and on and on, because it's going to be awesome. So thank you so much. Yay! There isn't a better time to have this panel than what's going on with the environment. So it's best opportunities, not risks, for 2023. I am super excited by the panel that I have. Normally, I just sit at my trading desk and see them on TV, but I get to have them here, and so do you. And given everything that's going on in the market, I think hearing each and every one of their views is going to be very, very interesting. With that, I'd love for each of them to introduce themselves and how great they are and their area of expertise, and then we'll kick off the opportunities. Hector?
Yes, hello, I'm Hector McNeil. I'm co-CEO and co-founder of Han ETF. Han ETF is actually my fourth ETF business. It's Europe's only white label, first white label ETF provider. Got around about 45 strategies, 20 clients, including a full range. We've got 14 big crypto spot products, which I know is always a big talking point in the US. We've got the biggest range of thematic equity ETFs as well, 25. And interestingly, talking about the last panel's carbon credit products, we have the world's first physically backed carbon credits product. And also probably the greenest gold ETF in the world that's backed by recycled gold, which is around about 95% less carbon intensive than mined gold. So that's really our offering as it stands at the moment.
Fantastic. Katie?
Hi, everyone. I am Katie Stockton. I am a CMT, and that means Chartered Market Technician. So I'm a technical analyst, which is a little unique, I think, with this audience, perhaps. Maybe there's some technicians in the room. So I am new to the ETF business. I launched an ETF in March called the Fairlead Tactical Sector ETF, or TAC, T-A-C-K. And I'm sort of riding up a very steep learning curve about ETFs in general, but happy to be here. I do technical analysis, research, and consulting for Fairlead Strategies. We have a team, 2 team members sitting right here in front of me. And we produce research for individuals, institutions, advisors, and we also consult them and help them navigate this kind of market volatility. My background is primarily on the sell side on Wall Street, with my most recent position being at BTIG, who is one of the sponsors of this event. So hello, BTIG out there. And yeah, I guess that's about it.
Jeremy Schwartz, I'm a global CIO at Wisdom Tree. Have been there now about 17 years, so been there from the very, very early days. Wisdom Tree, global ETF sponsor, around $75 billion around the world from US and Europe. We have some experience with Hector from our European days. We start off as all equities. When we first launched with Professor Siegel, our senior strategy advisor, that was my connection to the firm back in 06. But I've really gone way beyond equities to fixed income. We've got the commodity and sort of more tactical business in some ways in Europe. But we also now have a big model portfolio offering and are doing a lot with models as well. So we can talk really around the world on really anything here.
Perfect.
I'm Nicholas Bonesack. I'm the CEO of Strategas Asset Management. We started Strategas about 20 years ago as a macro research house, so we're very focused on sort of everything in that realm of the world. And a big part of our practice is identifying sort of the themes in the moment that are moving the markets. And so we started our asset management business about a decade ago, focused on thematic rotation, trying to identify sort of, as Gretzky would say, where the puck is going to be. We launched 2 exchange-traded products, one focused on intermediate-term themes, out 12, 15, 24 months on the time horizon earlier this year, and we launched a global policy themed ETF at the same time earlier last year. So we're really starting from the research side of the house, as Katie is, and taking it all the way down to the investable conclusion as well.
Wonderful. So before we start the discussion opportunities, I'd love to level set and get your opinion on the current market environment. Nick, you in particular have a macro rotation strategy. What themes are in favor right now? What are you seeing?
So this has been a great year for macro. It's kind of been the comeback a little bit. There's always room for it since the financial crisis. But if you think about where we were at the beginning of the year, there was some disbelief that the economy could slow, frankly, that we were sort of potentially at the precipice of a recession. There's a lot of gnawing of teeth in terms of how the Fed would comport itself. And of course, Russia, when we think about the beginning part of the year, really wasn't even on the horizon as it relates to the Ukraine. So this year has really brought it all back into the fore for us. I'd say the first theme that we really feel most strongly about is this idea of inflation for longer. We sort of never brought into the transient arguments that were either laid out or hoped for by the Fed. So inflation for us remains something that's very much in the fore. And I think when you consider just how aggressive the Fed has been, another theme that we think will play out and is going to be with us for some time is quantitative tightening. I can tell you amongst institutional investors, there's probably a much stronger appreciation, but amongst advisors and retail investors, there really is almost no acknowledgement about quantitative tightening, its effects, and just how pervasive tightening of monetary conditions can be. Our third theme in that regard would be slowing economic growth. We don't harbor a terrifically optimistic global economic call at the moment. Our proclivity is to be hugely bullish, but right now it's very difficult for us to build that framework. So inflation for longer, quantitative tightening, slowing economic growth would be the three sort of economic business cycle related themes. And then the fourth for us is deglobalization, which we can pick apart at great length later on if there's time.
That's very interesting. I actually had a discussion with someone about that, deglobalization and comparative advantage going away and some other things. So, Jeremy, you have a way broader research mandate at WisdomTree. What are your thoughts? Do you have some unique and similar views?
I guess just to follow up on that, and being that it's all being driven by the Fed and inflation and some of the comments there, I do think that the challenge for the markets and risk is we think the Fed is being way over tight. And so we were early in being with Professor Siegel. I'm sure a lot of people have seen his rant saying inflation is now done, in his view, that the actual inflation data is not what the Fed is looking at. So like they're using core PCEs, core CPIs that has a housing number that's going to keep showing inflation for the next 12 months, when who thinks that housing prices are going up right now? Is anybody's house price going up right now? No, I mean, they're all going down. 7% mortgages, real-time rent, housing is going down. But in inflation that the Fed is looking at, it's going to keep going up. And so, they're going to, in a way, they should pause. Like, they should pause today. They're going to do 50, and then they'll keep going. Bullard's out there, I just sent it to our team, saying 5 to 5.25 at a minimum, when we think they should stop. And so I think that's the risk for all the economy, and inflation might settle out. We think inflation will just be sticky. The huge money supply growth that's in the system will have to come out. But now the money supply is declining. In the 6-month basis, is going down. You want the money supply to grow at 5% a year, and it's going down. So all these are risks for, I think, the markets next year. The Fed's being way over tight. And so that what's happening in equities is been a massive rotation away from growth and sort of the biggest growth stocks, the highest multiple stocks, towards traditional value. And even within value, it's not just value, it's high dividend, defensive places. Some of that's the energy stocks, which have been driving some of the inflation that's staying longer. But we think in real time, inflation's coming down. Fed doesn't have to be as tight, and that'll have all sorts of implications for where you invest. But I think a lot of it's going to be continued of what worked this year is going to continue working in our view. Because we still think there's multiple compression on the more expensive growth stocks. I think value stocks, when we look at high dividend stocks at 12 PEs, that to me is still very attractive in the US. You get even lower internationally. So I think that could continue working, but the growth area could come under pressure still.
Fantastic. And Katie, you're a technician. What are you seeing as far as, your views, the S&P, the dollar, Treasury? I'm sure you have some unique views there.
I wish I had a happier message. This is getting a little depressing, right? But as a technician, as you can imagine, it's a downtrend, right? We have lower highs and lower lows for the major indices in the equity market. And it really is all macro driven. So to have an understanding of the directional bias, short-term, intermediate-term, long-term across the board for yields and the dollar, it's really essential at this time. It'll probably remain essential until we get out of this tightening cycle. So we're really hyper-focused on the short-term directional bias to help our clients navigate the volatility. Right now, we're in the midst of a relief rally, and we'll take what we can get out of this market on the upside. We do think that relief rally actually has room to persist here in the near term for the likes of the S&P 500, even driven perhaps by mega caps, which are all pretty much broken except for Apple, but have oversold indications and are due for more of a bounce in here. And we would, generally speaking, be using relief rallies to reduce exposure because we think we're in store for really more of the same, but also even potentially some kind of volatility event. And maybe that event comes from something that's not a widely known subject right now. That's often the case. But if you run a comparison of the volatility index to 2008, it's eerily similar towards, before we got that kind of like 80, 90 spike in the VIX. So we hope we don't have to see that before this market can bottom on the equity front. But we certainly think that we need a reading of like maybe 50 for the VIX. And the levels that we're watching for the S&P 500, because as a technician, it is all about where is support, where is resistance. For support for the S&P 500, 3,500 is really the initial level that holds any importance. But we had an earlier breakdown that projected to about 3,200. We think that's a realistic level for sometime later in the first half, perhaps, of next year. And with that in mind, I think if we're looking for opportunities, more of the same with whatever was working this year, which feels like not very much, but energy and on the sector front is really the last man standing in terms of long-term uptrends out there. Otherwise, we had to live in like a relative world, looking for phases of relative performance that we can leverage in different ways.
Wonderful. And feel free to ask questions while we're going on. I think it's a very interactive type of discussion here, and as they, have their view, share their views, I think it would be interesting to have some dialogue back and forth. And then I'll go along over to Hector here. He's a very a view from Europe as well as what's been really trendy, which is thematics. I'd love to hear a bit about that as well.
Yeah, I suppose I'm the diversity card here today with being from Europe. First of all, I'd like to just apologise for the UK and how we seem to be completely destroying our reputation around the world as it stands at the moment.
Give us a chance.
Well, that's it. I think we started all with Brexit, to be honest. But it's. I think certainly what we're seeing in Europe is obviously a massive preoccupation around energy and cost of living, which because obviously we're so close to proximity of the war in Ukraine. I think it's had a seismic impact really on people's everyday lives really, and certainly everyone's scratching their head to sort of figure out how do we do the transition from fossil fuels when obviously there's not much of an alternative. But it's actually speeded a lot of things up. Big focus on uranium and nuclear. That was really dirty word, particularly in the northern part of Europe up until very recently. But it's actually suddenly become front and center as part of the energy solution. And certainly I think countries, where in the past, some countries like Sweden, etc., wouldn't have even considered this as a solution. Now it's front and center. So I think the sort of renewable energy story, clean energy story is going to be a big one, particularly when you're so reliant on single points of failure, whether that's pipelines from Russia or gas pipes, from Norway to the UK or whatever. So I think that's where we're sort of trying to effectively get our heads out of our asses, really, to be honest, when it comes to this. So it's extremely short term, and I think the realization is that and I think the Russian mistake has been here that we've got a reliance on it. But ultimately, I think that's going to make something that was a long-term goal become a medium-term goal. I mean, I was reading something the other day that Italy's already ordered 500,000 heat pumps, for distribution. The UK had a budget today and massive focus on insulating homes. So I think, when we talk about thematics, I would say that the energy transition and clean energy is going to be a massive focus. I mean, interestingly, the discussion we had just before on ESG, you know, I found quite bizarre. That to me was a discussion we were having 20 years ago, you know, and you know, I would say that we have a standard in Europe called SFDR, which is where we grade each fund by its ESG rating. It's all encapsulated in law. To the point where you know, a very senior Deutsche Bank executive was recently arrested for greenwashing, so it's taken very seriously. And I would say that the long and short of that is that the top two standards, which are SFDR 8 and 9, are pretty much the only way that you can sell a fund in Europe now. So if you're below that, you're not going to sell, and SFDR 8 is probably the minimum that people are looking for. You know, so I think that hand-in-hand ESG and the sort of energy transition is really where the thematic plays are in the market. I mean, obviously there was a big interest in tech thematics a year ago, but obviously that's gone out the window. And you know, we're talking a little bit about the globalization story. You know, something like onshoring is going to be a big play as well. But I'd say most of the action in Europe is around that sort of energy transition and ESG story as it stands.
I totally agree with you. Actually, I was going to pivot and ask you that, 'cause given the panel earlier. I think one of the most striking things I saw when I went out to Europe and met with different asset managers and investors was how focused they were on ESG, and the fact that and what is it, Article 8, Article 9 in those standards, and minimum of Article 8, and you had to actually follow those standards in order to get your product to market, where in the US you had quite the opposite. The word ESG fell under so much fire. So that panel earlier was very interesting. I don't know if you guys are looking at me, so please, I mean, not to extend the ESG discussion, but thematics and what's in favor.
Just one final point on that. I think what was really interesting with the SFDR standards is that only last week iShares actually downgraded several of their Article 9 products to Article 8. And really, that just comes down to the fact that you know, people are very conscious that they're being looked over their shoulder in terms of what they're doing in this space. So it's a very critical aspect. And as I say, I did find that previous panel absolutely astounding, and I wouldn't have even thought of hearing that 10 years ago in Europe. So it definitely is front and center in the investor's mind.
I think Jeremy has some
I'll just say quickly, because we don't need to make it into an ESG panel. I mean, I could confirm everything what Hector's saying.
Opportunities.
And I oversee a global indexing business. We have, I've half the team in Europe, half the team in the U.S. And in Europe, if you don't have ESG as part of the criteria, they won't talk to me. It's like every index we do must have the basic filters, basic screening. They're working on Article 9 as a very top priority. Whereas here, it's definitely a different conversation.
You don't even want to say it now because there's no standardization, so you don't want to get called out on greenwashing or any of that.
And the regulators are very different, and there it's very encouraged, and here there's all sorts of questions in the U.S. So
go ahead. No, you have a view.
I guess from our vantage point, I think the question on ESG and almost any other thematic approach is, what are you trying to solve for, right? And most of the investors that we're working with, as I imagine you are in some degree, are trying to find alpha. Right, so that ESG works for you when it's in vogue and when it has momentum. And right now, I think to Hector's point, it doesn't. It's the other way. And so, we've had an anti-ESG fund in many ways this year. Not because we're anti-ESG, just because it seems to me that those base carbon extraction themes are sort of doing very well as Europe grapples with its own crisis. So I think that's important. And I think the other thing that we struggle with is why E and S and G are inextricably linked for all time. I think if you want to have an environmental fund, you can find many alternatives to get there. If you want to have a socially conscious fund, you can do that. Good governance. I can think of a lot of energy companies that extract precious metals from the earth that are extremely well run and probably score top draw on a governance side of the equation. So I think we sort of default back to what are you trying to solve for, and it just doesn't seem that those three, that acronym is working for the time being.
I mean, you could say this whole trend is one of the things that makes your inflation for longer, the energy for longer, because lack of capex, lack of spending. You sort of, and to Hector's apologizing for all of Europe, what were they thinking on some of these policies that they're in a real bind on the energy across all of Europe. It's a real tricky situation, and so you could see. I mean, I could make a very bullish case on oil and energy over the long term because of the decarbonization trends that people are talking about. You could say that's very supportive for oil and those kind of things.
So unless Katie had.
Well, I look at things from a trend following perspective, and your point on momentum, it really is all about riding the momentum in areas of the market that have it, right? It's been very difficult to find that, and energy has been one. We've noticed, unfortunately, that in energy, as much as we can understand the fundamental case or the macro case for the sort of energy bull market behind WTI crude oil and the likes to continue, there's been a very significant loss of long-term upside momentum there. So we don't think that energy will be the sector that it has been over the past 2 years necessarily. It's often the case with sector rotation that the top dog sort of ultimately falls out of favor at some point. So we haven't really seen that yet in relative strength terms, but it's something that we wouldn't be too surprised by.
Well, thank you for your thoughts on that. Now, since we're talking about all of the headline risk opportunities, risks, everything else out there, I'd love to hear your thoughts, given what's been going on this week on crypto. And I know, Katie, you had some specific ideas there.
This is where sometimes it's not great to be a technical analyst because I can have an opinion on anything that has a price, which includes crypto. So we always stick our neck out there on Bitcoin and Ether. We publish a weekly report on it. And it's been hard to watch, quite frankly. And obviously there's a big shakeout in the industry as it stands. We're trying to look at it very, purely from a technical perspective, where we're watching supply and demand, where has it met buyers in the past. And unfortunately, Bitcoin, for one, has taken out a very significant support level. For us, that was 18,300. It was, in part, a Fibonacci retracement level for the technicians out there. And it's left pending confirmation of that breakdown this week. So we have a potential major breakdown in Bitcoin. And if that's happening, obviously, that kind of ruins the confidence behind many of the altcoins out there. And unfortunately, the next support for Bitcoin is down south of 14,000. When you look at the chart, it doesn't even look that far off. It's just that's the kind of volatility that it's sort of withstood. We've had a very positive correlation over sort of recent past for Bitcoin and others versus the NASDAQ 100. So it's been treated as a risk asset, and sort of growthy and technology, all of it can be tied together. We did see that sort of break up very briefly last week, but kind of snapped right back to it. So we think we're looking for more of the same, and we do worry about the crypto market. If we do see downside follow through, that could ultimately provide a little bit of a contagion elsewhere in other risk assets. But as it stands, we do have some signs of downside exhaustion. So there's some signals that we have in Bitcoin that we haven't seen in many, many months that do support stabilization here in the near term. So going back to that idea that we can actually see a little upside follow through here for risk assets, equities included, we think there's some limited short-term downside. Unfortunately, it doesn't mean that the bear market cycle is over.
I mean, I'm surprised it hasn't gone down more based on everything going on. There's been a lot of, with the FTX stuff is crazy.
It started off with the TV following him around, like racing up the steps. I mean, what were your thoughts on that?
It takes away any kind of confidence that you can have, right? People are losing jobs, and it's very difficult to watch. The industry as a whole, you're seeing the shakeout, and the shakeout was bound to happen, but it's just too bad that this was the impetus for it, because I think it just sort of further delays the institutional adoption of cryptocurrencies as an asset class.
You said 14,000.
Right, yeah, 13,850 is the precise level. It's a former resistance area.
You see, I'm not so sure that's true about the institutional adoption. I think the asset class is actually mainstreamed quite dramatically over the last 2 years, and we're certainly not seeing any lack of momentum in that. In terms of, since we launched an ETF, we've had over 1,000 inquiries for people wanting to do ETFs, and I'd say 1/3 of those have been crypto related. And as I mentioned, we've got 14 physically backed coins. And actually, in the last 2 weeks, bizarrely, and I don't have an answer for it, all we've had is positive days of inflows. particularly over the last 4 to 5 days, and we haven't seen that for a long time in the asset class. I mean, I think generally that I mean, I'm no advocate or champion of cryptos, but I do think the horse has bolted. I think there's a massive momentum behind that section. It feels very much like the dot-com boom did to me in the mid-90s, actually, where you had insane valuations. I mean, I was at Morgan Stanley when we floated lastminute.com, and the company floated on an £800 million valuation, and its revenues were less than $1 million. So, and it was valued based on the number of subscribers to the website, and you could only get access to a new issue if you became a subscriber to the website. So it went up 30-fold in valuation over a 3-week period. Now that to me feels very much like this industry where you had this massive fallout in the dot-com world, and then the Amazons of the world, et cetera, emerged out the other side of that. But you needed that sort of clear out, beforehand. And the funny thing about seeing what's happened this week is we've seen it all before, haven't we? It's perennially every other generation it happens in financial services where we get a bubble, everybody gets carried away, and then we always say, why didn't we see this coming? Why did we do this? Well, we've done it before. It really is where people are making money. Everybody wants to be there, right? And the standards of due diligence and scrutiny on businesses goes out the window because people want to make money. So, it doesn't surprise me, but I do think it's just part of the general, adoption of the technology and the way forward. So I don't think this is gone. It was very, I think, at the side and very cultish, but I think it's definitely gone mainstream. Certainly, it's gone mainstream in Europe over the past couple of years, and I don't think that's going to change.
Okay, wonderful. Thank you. Jeremy, I know, let's pivot a little bit here. I know you mentioned the Fed rate hikes and the trajectory of possibly Fed making mistakes. How is that translating into fixed income as an asset class?
Yeah, so for us this year, we've had breakout success in a floating rate treasury strategy, USFR. It's raised about $10 billion this year, and it's basically the shortest duration product in the market with a 1-week duration. So if you think the Fed's going to keep going more with, let's just say Bullard's right, they're going to get at least 525, you've got another 125 basis points, 1-week duration, it's been capturing the rates the fastest. So it's like one of the only positive things on people's screens this year is that. So that's been incredibly positive. From a longer run rates perspective, I would say where real rates have come, the sort of 10-year TIPS yield went from being insane at negative 1% real rates to now actually offering real rates. So you've had like a 250 basis point plus move in the long end of or really across the real rates curve. From a long run perspective, 1.5% doesn't sound like a lot of real interest, real rate interest in that TIPS yield, but it may be actually above fair value. Anything could happen in the short run. It could keep trending higher, but what we've been saying, Professor Siegel, in the 6th edition of his book, Stocks for Long Run, just came out. If you get a copy, we have a whole chapter on interest rates and the trends for longer-term interest rates, demographics, GDP growth, productivity. All these things have caused what we think is sort of a lower normal. And that lower normal is probably below 1%, maybe closer to 0 on the real rates, which is a big statement. But so you might be above fair value. Now, what could keep it going? Anything could keep the momentum going in the short run. But on the longer run basis, we might say real rates would pressure back down. And then, again, we view sort of the Fed being too tight. So all these things would be slower growth and sort of potentially good for the long end. But this inverted curve makes a lot of yield pickup just at the short end of the curve. And I know you guys talk a lot about inverted curve causing a recession. I've talked with Tim on your team about that specific issue.
Yeah, I think, from our vantage point, I think we have to remember what the Fed is and what the Fed is not. And the Fed is, heavy on PhDs, particularly at the policy making. And that doesn't instill a lot of confidence, maybe. But, it's heavy on sort of an academic model-driven approach. And when you talk to policymakers, particularly sort of at the upper echelons of the Fed and the research department at the policymaking level, they are very loath to repeat the mistakes that they feel the institution made in the 1970s, which was this application of a stop-and-go monetary policy where they thought they had curbed inflation, and then they went back to try and address growth, and then inflation came roaring back to a higher high, and then they did it again, and then inflation came back a third time, and straight on through from the Nixon Johnson administration right on through to even the early days of the Reagan administration. So the Fed wants to ensure that they've got inflation nipped in the bud, and I think that's what they're trying to solve for. And as long as we keep talking to capital markets participants and they think the Fed's going to bail them out, then monetary policy isn't tight enough, right? And they're just going to keep going, and that may mean 50 basis points in December and holding the rate steady for an extended period of time, but we should not anticipate that the Fed is going to come and reverse course. And moreover, I'd say the only other thing I'd offer to that is we've had some very generous opportunities to talk with some former members of the FOMC, some regional presidents, some governors as well, and we ask them the same question every single time. We say, there's this old adage that the Fed, hikes until something breaks. So do you guys keep a list? Like how do you sort of handicap that? And I swear to you, a former regional Fed president looked me straight in the eye and said, we're often as surprised as the market is. So that also doesn't instill a tremendous amount of confidence.
That makes sense given the interview, because the markets shot up because it was like we're going to halt. Yeah. And then when you actually saw the interview, it went the other way. Does that kind of line up with when you?
That's exactly what it was. So I think the Fed is not here to bail out risk assets, and the Fed will tighten until something breaks, or at a minimum, whether it's overtly the policy rate or policy rate plus some sort of balance sheet maneuvers. I think we've got to contend with the Fed for some time.
I know the rest of the panel has some views, and Katie, you have some views on this as well.
Not as much on the Fed. I'll leave that to you guys.
Okay.
But just in terms of the reaction, right? We want to always respect the prevailing trends, and of course, we consider the timing of the meetings as potential sort of volatility events in and of themselves. So we're very respectful of what they're doing. We have no opinion on when they'll pause, if they'll pause, when they'll reverse. But more importantly, we want to just try to manage risk through this kind of environment, which we know there is a lot of risk to it. So it puts us in a position where, none of us can really be like with zero exposure for the most part. If we can, that's sort of a luxury, right? If we can just sit fully in cash. A lot of us have clients who need to be at least partially invested. So it's about choosing kind of the best of the worst in this environment, looking for something that has some safety to it. And if you look at what's outperformed year to date, short-term treasuries, gold, now more so than before, gold and precious metals. And gold and precious metals and even some industrial metals to us remain an opportunity, and an opportunity that feels like it has more safety than trying to capture a 3-week bounce in Tesla. So that's one of the things that we're recommending to our clients is to consider that precious metals exposure. The Treasury bear market we think will be perhaps less pronounced than it was this year, next year. But we do actually think there's potential for 10-year yields to move as high as about 5.25. And I sit around with a lot of macro folks, and I often put out a number, and it seems crazy. And then sure enough, they move so fast, faster than we all tend to expect. So in terms of levels for the 10-year, we had a big breakout on that chart, and not just a breakout, but like a multi-decade reversal higher. And we think that could have multi-decade implications. It doesn't mean we won't have off years where we're seeing them trend lower, but the most recent breakout above 4% did target about 5.25 with a projected time frame of somewhere towards the middle of next year. So we think that's viable. And in the interim, we're looking for more corrective action, which we feel like is kind of a gift to the markets here temporarily.
5.25, that's a big statement. It'll be interesting.
On the record.
Questions on that? So let's shift to shinier skies and happier times. So Hector, what are some, I know you apologized for Europe, but what are some areas, pockets of opportunity that you see going forward for 2023?
Couple of areas I quite like. I quite like defence. I think there's going to be a big, massive expenditure increase in that, particularly defence in the real term of the word as well, rather than offence. So I think the whole pressure on NATO is going to be significant. I mean, I was watching CNN today, and they were saying that all the NATO countries are actually running out of ammunition and bullets, etc., and missiles, and that's all going to need to be replenished, and probably raised. As we know, outside a few countries, most of the NATO countries haven't been meeting their 2% requirements, and I think it's pretty hard for them to step away from that now. So I think there's going to be a lot of pressure on there. Obviously, that's coming at a bad time for most people regarding their ability to pay for that. But I think that's going to be a big area. Other themes I quite like onshoring. I think that's going to be quite a big theme going forward, and I think that could be quite a nice long-term trend as well. Probably, as we've had a couple of shocks, which 2008 and now, which has shown there's probably a need for that, particularly for some sort of social stability. Those are the sort of two areas which I quite like, and I really like gold as well. I've always been a massive gold bug. I was part of the team that created the world's first gold ETF way before GLD came to market. So, I'm a massive fan of that. And I do think that, good point about the precious metals. I would say that the white metals are probably well worth a look as well, but probably more, from a viewpoint of their commodity value rather than the precious metals value. But certainly gold is certainly an area we're seeing a lot of interest in.
How about Nick? What about from a macro thematic standpoint? Do you have some predictions?
Yeah, I think predictions. So these you can get wrong. You just have to guess. But I would say a couple things. I'd say first off, one of the things I learned just in the last couple of weeks, as we sort of zeroed in and gotten through the elections here in the States, is that just over 60% of the U.S. federal budget is linked to inflation. So if you want to look for places where prices are rising and who's going to benefit, you talk about defense. There's a lot of other pockets. Defense is certainly one of them, and we would agree with that. Probably as an incremental as well. But there's 60% of the things that the federal government, United States federal government, spends money on is going to get a raise. So we want to follow the money in that regard. And to the extent to which economic growth may be slowing, and people may unfortunately lose their jobs, that may also result in an increase in transfer payments as well. So it may consume more of the federal budget and be more transfer of money and subsidies from the federal into folks' wallets. And we know how that played out during COVID, so we'll want to continue to watch that thematically as we move into next year. And the other thing I think, in crypto is an interesting entry point for this type of conversation, but it permeates a lot of different areas, is that, when we struggle through recession, when sort of the big story is about things breaking down and pain and, slower and sort of a contraction generally, there's generally a bull market in the plumbing, right? So you don't love Ether, you don't love Bitcoin, you don't love some of these other coins, or, payments, or, oh my goodness, you can buy anything you want on an app. But when you're not getting the headline, you tend to reinvest in the business, and that's where you get a lot of strength. There was as much opportunity to invest in technology in 1996, 97, 98 as there was in 2001, 2002, 2003, when they fixed the plumbing and they sort of connected the dots. And I think that's going to be a real opportunity, not just for cryptocurrency, but for a lot of other areas. And when you consider beyond crypto, what we're dealing with in the global financial realm, the post-World War II settlement conventions, whether they be trade or they be anything else, they're antiquated. And so we really like the plumbing of the global economy as a bull market opportunity.
Fantastic. And Jeremy, I know you mentioned value versus growth, maybe some small mid-cap versus mega-cap. Are those opportunities you're seeing?
Yeah, and now I talked about where I think the Fed's making this mistake and perhaps overly tightens us into a deeper slowdown and say, well, do you want small caps in that view when they're more sensitive to the economy, more cyclical? But the way I look at valuations, at least on if you have any kind of basic profit tilt or dividend requirement, we have 3 different small cap fundamentally based strategies. They're all a few weeks ago, they were 10 PEs. Now they have a 20% rally, they're at 12 PEs. But 12 PE was an 8% earnings yield compared to sort of large cap growth at sort of 10 PE points higher in the 20s. To me, that's still where you want to be, actually. Like, I think there's more pressure on the more expensive stocks. Like, Amazon's not a cheap stock. Tesla's not a cheap stock. Like, that's where you could have pressure, I think, in some of these things. And I think the small cap value side is actually where you want to be, even though you might have a slowdown in the economy. So I think that's some of the places that we tend to like.
How about Katie?
Yeah, I mean, I would affirm the relative strength calls that you're making in that maybe small caps over large caps. I still think it's U.S. over international. I do think the mega caps are challenged. I think the market won't bottom until Apple bottoms. And if you look at Apple on a monthly bar chart, it looks a little bit toppy still. So if we can look forward to that bottom, though, usually what happens is we come out of it full force with technology, consumer discretionary, mega cap leadership, sort of rotation back into growth from value. So that's where we want to be sort of ready to add exposure into weakness and to try to be somewhat systematic in approaching that weakness and make sure, one, you're not too early, wait for the momentum to turn. But to do so systematically is a way to take some of the emotions out of it, because what I found is that these corrective lows or market bottoms, folks are a little bit too slow to get back to their proper full exposure when the market goes back to risk on, when we can be more offensive. So to really track the indicators and the gauges that will tell us when momentum has made that turn. And then I would also say sort of active over passive right now, unless you're short-term in your orientation. In terms of ETF, to trust that the active ETFs have ways to navigate this type of environment. And if you're going to do it yourself with passive ETFs, to actually be a little bit more short-term in your orientation and more sensitive to the momentum swings.
It's actually an interesting point. I know there was a discussion on active ETFs. Does anybody else have any ideas or view on active versus passive they want to talk about? Or I know, Katie, that's something you and I talked about ahead of the panel.
Yeah, I mean, we are big believers in active. I think in the last decade, and you all know this better than certainly I do, but if you think about the big three growth pockets of AUM, there's certainly the indexed, and that runs the gamut from sort of the major tracking funds all the way down to sort of backdoor active, make your own index and then track it. I love the growth in the retail access point market, the ability for advisors to put their clients into commodities or put their clients into rates or FX pairs. But I think thematic, for me is sort of the next big growth area. Now, of course, I'm speaking our book, but we got into that largely on account of the fact that we do think active share will increase. I think when you take away free money, it requires a more disciplined approach, and you can't be as cavalier in your allocation. So whether it's individual securities, whether it's sector and asset allocation rotation, or it's a thematic rotation approach, I really believe that that'll be an area of significant asset growth over the next couple of years.
You won't find a lot of disagreement from me, even though we're maybe more passive than they are in some sense. But we are, I'd say, systematically active is the way I would describe Wisdom Tree at the end of the day, is that we are creating rules, trying to, and even directionally, we've gone more active in what we've done over the last 16, 17 years, that it's been taking more active bets. I think if you're just going to make a slight tilt on the S&P, that's not as interesting as if you actually can deviate. I mean, like our high dividend basket is having its best year in 16 years. It's ahead of the S&P by 2,000 basis points this year. So it's telling you it's not exactly the S&P 500. I mean, those are high dividend stocks that are really working. So I think I generally agree. And I think models is one of the ways we're expressing it for people is using model portfolios to help deliver, customize, collaborate with our advisor clients to get the type of tilts that they want, achieve their goals. So things like what Katie's doing and what Strategic is doing, I think, are very in line with our view.
No, I totally agree with that. I mean, just from my own seat, since I see all the issuers come through and what they're launching and what we're seeding and things like that, most of the launches have been in the active space. They've been active, transparent, but when you do see a rules-based strategy, just because it's passive in terms of like the wrapper, doesn't mean the underlying investment strategy is passive. I ran a fund that was very active. It was under the passive relief. So I totally get, and I think that's super interesting for investors and opportunities that investors have that they hadn't had before, just beyond the broad market indices. So I am actually very excited to see what comes next in innovation in terms of what people are bringing to the ETF space. Some of your strategies have been fantastic, just learning about you guys and the things you're doing. I know all of you guys have a product to market, right, of all of the themes that you spoke about. I'd like to kind of summarize a little bit here with each of you, maybe talking about, you talked a lot, so maybe your top risk and let's end it with top opportunity of where you see some shininess.
Yeah, I can start. I mean, I think the biggest risk if you're trying to solve for higher asset prices is the Fed making its policy mistake. And I'd put a very high confidence interval on the Fed making a policy mistake. But they don't view it that way, as we've talked about. So that's in where the opportunity lies. And I think if we can take a more sort of granular approach to allocating around that type of outlook, you'll be in good form. So on the intermediate side with our SAMT, which is our macro thematic opportunities fund, the risk is right in front of you, and the question is how you position around it. We've not talked a ton about politics, but I would summarize it to say this. The U.S. electorate has turned out the party in power in 8 of the last 9 elections, right? And they did it again, 2 weeks ago. So, we're clearly on this, we clearly remain on the fine line of gridlock. And we're agnostic, frankly, as to who the party in power is. We're really interested in what policy outcomes sort of emanate from that. And I would expect, even if you're just a sideline observer, a very active lame duck session. You can already see some of the incumbent Republican senators sort of pushing back a little bit on Leader McConnell in terms of making a deal with the White House or Speaker Pelosi while she remains with the gavel at hand. So very, very active very active window of time coming up here over the next couple of months.
Perfect. Jeremy.
I fully agree. That's how we started. Fed mistake. So USFR is the Fed keeping aggressive too long. If Katie's right, 525 on the 10-year, you want to stay in USFR for at least till we get to 525. So USFR, I think, is the Fed play. DHS is the high dividend defensive, cheap stocks. The sectors are in the energy stocks that you want. The overall low volatility approach, I think, is where you want to go. The other global geopolitics risk that we just launched a pretty new fund and got some interesting flow right away was ex-China, ex-state-owned enterprises. So XC is a ticker. We built this franchise on EM. We have a few $billion in an ex-state-owned generally, but the ex-China, I think, is a particular risk. You saw a lot. If you say what is the other wild card on geopolitical stage, we haven't really talked about China, but that's where there's another geopolitical dynamic that maybe it's not next year, but over the next few years, I think that could continue to be an issue. So I think XC should be a fund on people's radar for EM.
Katie?
Great. Well, I think, cyclical bear to a secular bear. That would be the biggest risk, right? So I think we're still in a cyclical bear and a secular bull. By the way the chart's set up, we still have long-term support levels intact. We have uptrending indicators, when you look at the monthlies and the quarterlies. So we do feel like we're still in this secular bull trend, and that would suggest that we ultimately will have this major low sometime next year. Now, there are some things like Amazon, for one, that are taking out these long-term levels that would indicate that it's more than just cyclical. So that, I think, is the biggest risk, that we're entering or have entered into something that's much more prolonged, more of like the 2000 to 2003 period versus the 2008 bear market cycle, which was a little bit more fast and furious and ended more abruptly. So that, I think, is the biggest risk and sort of my biggest fear, because it's a really difficult environment to navigate. And then opportunity-wise, we always, we're more fluid in our analysis. We always reserve the right to change our minds. So, but I would say for right now, intermediate term, it probably is the metals complex. We feel pretty good about that. And, commodity prices in general, as much as crude oil is sort of now perhaps range-bound for a while, we still do believe that there's opportunities there in grains and elsewhere.
And Hector, I know we can shine the light back on Europe.
Yeah, I think energy, inflation, and civil unrest. I think there's a massive potential for civil unrest in Europe, and maybe even beyond that. Particularly where people, won't be able to feed themselves, and it generally. I mean, they had a budget today, which basically, put the largest tax burden on the UK since the Second World War. And reducing living standards from 20 to 20 years ago. So, and every week you're seeing protests in London, and across Europe We've seen a far-right government being installed in Italy. Obviously we don't know which way the Ukraine and Russia war, obviously we saw the stray missile. We still don't know whether that was really Ukraine or was Russia. So not very rosy, really, to be honest. But I think that's really what we're going to see. Opportunities-wise, I would say probably uranium. I agree on the metals, but I think uranium in particular, because I think there's going to be a huge amount of investment goes into that.
Wonderful. I found this very interesting. I think you guys all come from very different backgrounds in terms of your investment styles, but we saw some really common themes emerge. We didn't even talk about that when we prepared, so it's very interesting for me. I hope it was very interesting for all of you. I don't know if you have any questions. Please go ahead. Andy, go ahead.
Any short opportunities?
Definitely. I think what we're waiting for to get out more vocal on short opportunities is for the relief rally to lose momentum. We always, just in our mindset, we want the short opportunities to be short-lived because we kind of are more accustomed to bull market cycles, but we've had a lot of success on the short side, and I think the charts are among the best way to find these shorts because the market at this time is very top-down in its orientation. The moves in the individual equities may not make a whole lot of sense at times from a fundamental perspective. So to make sure we have that broader market view on our side, and then we can kind of pick the higher beta names that we feel are better shorts and put them out. And I think we'll have an opportunity within the next few weeks to do that. Oh, no, not shorting in our ETF, no. Asset allocation.
All right. Anybody else? All right, well, thank you so much for your time. I love the full room. I'm sure they do. Thanks again.
Thanks, Julie. All right, thank you, everyone. So in closing, I'd like to thank Julie, this panel, thank all the panelists for the great discussion and insights today. I'd like to thank our sponsors, again, for helping us put on this good conference and a good time today. I'd like to thank the staff that helped us here. I'd like to thank all of you for coming and joining us. One note, we put the ETP Forum on 2 times a year, so the next conference will be here on May 25th in the spring, so in the fall and the spring, so in the spring on May 25th. And thank you again. Thanks all for coming.